I sat across the table from a man named Robert Lindeman last April, and he looked me dead in the eye and said, "Hal, my accountant told me if I keep doing what I'm doing, I'm going to pay over $18,000 in federal taxes this year on my Social Security. She said there's a way to cut that number down to zero. Is she right?" And I had to tell him the truth. I said, "Robert, she's not just right, she's late. You should have done this 3 years ago." Robert was 62 years old. He had worked 41 years as a facilities manager for a hospital system in Raleigh. He retired at 61 with a pension of $43,000 a year and started collecting Social Security at 62 because he thought waiting made no sense if he had other income. His monthly Social Security benefit was $2,200. That's $26,400 a year. Add the pension, and his total income was $69,400. He was single. He filed his taxes as a single filer, and under the current tax code, that put him in a position where 85% of his Social Security was subject to federal income tax. Let me say that again. 85% of the $26,400 he received from Social Security every year was being counted as taxable income. That's $22,440 added to his taxable income on top of the $43,000 pension. So his adjusted gross income for tax purposes was over $65,000, and after the standard deduction he was paying federal tax on a significant portion of that. His CPA ran the numbers and told him he was going to owe around $18,000 in combined federal and state taxes for the year. $18,000 on an income that was supposed to carry him through retirement. Robert sat in my office with a folder full of tax documents and a look on his face I have seen 1,000 times. It's the look of someone who played by the rules their entire life, paid into the system every single paycheck, did everything they were told to do, and now feels like the system is punishing them for it. He said, "Hal, I thought Social Security wasn't taxed. I thought that was the whole point." And I had to explain to him what nobody explained when he filed at 62. I had to explain that Social Security absolutely can be taxed, and depending on your other income, up to 85% of it is fair game for the IRS. But here's the part that made me angry on his behalf. Robert's CPA had only recently told him about a strategy that could have saved him tens of thousands of dollars if he had known about it before he filed for Social Security. The strategy is called a Roth conversion ladder, and it is one of the most powerful tools available to retirees who have traditional IRAs or 401ks and want to minimize the tax bite on their Social Security benefits. But Robert didn't have a traditional IRA, he had a pension, and because he had already filed for Social Security, the window to use the strategy in its most effective form had closed. Robert's CPA told him there was still something he could do. She told him he could reduce his taxable income by making strategic charitable contributions using a qualified charitable distribution from an IRA if he had one, or by restructuring how he received his pension income if the plan allowed it. But Robert didn't have an IRA with enough in it to make a QCD worthwhile. His pension was a fixed monthly payment. There was no restructuring option. The CPA had given him good advice for someone in a different situation. For Robert, it was too late. I looked at Robert and I said, "The advice your CPA gave you is real. It works, but it works best when you do it before you file for Social Security, and it works best when you have the right kind of accounts to pull from." Robert asked me if there was anything he could do now. I told him the truth. I said, "You can stop the bleeding, but you can't undo the damage. You're going to pay taxes on your Social Security for the rest of your life unless your income changes dramatically. The best thing you can do now is make sure you don't make it worse." Robert's story is not unique. I see versions of it every single month, and what makes me the most frustrated is that in almost every case, the problem could have been avoided if someone had explained the rules before the person made the irreversible decision to file for Social Security. So let me explain those rules to you right now. because if you are anywhere near 62 and you have other sources of retirement income, you need to understand exactly how Social Security taxation works before you file. The federal government taxes Social Security benefits based on something called your combined income. Combined income is not the same as your adjusted gross income. It is a separate calculation, and it is the number that determines whether any of your Social Security gets taxed and how much. Combined income is calculated by taking your adjusted gross income, adding any tax-exempt interest you earned, and then adding 1/2 of your Social Security benefits. That total is your combined income. If you are filing as a single person and your combined income is between $25,000 and $34,000, up to 50% of your Social Security benefits become taxable. If your combined income is above $34,000, up to 85% of your benefits become taxable. For married couples filing jointly, the thresholds are $32,000 to $44,000 for 50% taxation, and anything above $44,000 triggers the 85% rate. Now here is the part that shocks people. Those thresholds have not changed since 1983. They are not indexed to inflation. They do not go up over time. A combined income of $34,000 in 1983 is not the same as $34,000 today, but the IRS does not care. The law has not changed. That means every single year more and more retirees cross those thresholds and start paying taxes on Social Security simply because the cost of living went up, but the tax brackets did not. Robert's combined income was well above $34,000. His pension alone put him over the limit, and because he filed for Social Security at 62, he locked in that tax situation for the rest of his life. There was no going back. Once you file for Social Security, you cannot unfill. You can suspend benefits if you are at full retirement age or older, but Robert was 62. Suspension was not an option. He was stuck. Now let me tell you about a woman named Patricia Voigt. Patricia came to see me 6 months before she turned 62. She had done her research, she had read articles, she had watched videos, and she walked into my office and said, "Hal, I want to file at 62 because I have $480,000 in a traditional IRA, and I want to leave it alone so it can grow. I'll live on Social Security and let the IRA compound for another 10 years. And I said, "Patricia, that is the exact opposite of what you should do." Patricia was widowed. Her husband died 8 years earlier. She had been collecting a survivor benefit since she turned 60, which was the smart move. She worked part-time as a bookkeeper, making about $18,000 a year. Her survivor benefit was around $1,900 a month. She planned to switch to her own benefit at 62, which would be about $2,100 a month. She thought she was being strategic. She thought letting the IRA grow untouched was the responsible move, but she had not considered the tax torpedo that was waiting for her at age 73. At 73, Patricia would be required to start taking required minimum distributions from that IRA. The RMD at 73 on a $480,000 IRA, assuming even modest growth, would be somewhere in the range of $20,000 to $25,000 per year. That entire amount would be added to her taxable income. Add her Social Security on top of that, and she would be paying taxes on 85% of her Social Security benefits plus the full RMD amount. Her tax bill at 73 would be more than double what it was at 62, and it would only get worse every year as the RMD percentage increased. I walked Patricia through a different strategy. I told her to delay filing for her own Social Security benefit as long as possible, ideally until 70. In the meantime, start converting chunks of that traditional IRA into a Roth IRA every single year. The goal was to convert as much as possible while staying under the threshold where Social Security becomes taxable. Since she was still collecting the survivor benefit and working part-time, her combined income was around $39,000. She had room to convert about $15,000 a year from the traditional IRA to a Roth without pushing herself into the 85% Social Security tax zone. If Patricia converted $15,000 a year from age 62 to age 70, that is $120,000 moved out of the traditional IRA and into a Roth where it would grow tax-free forever. The RMD at 73 would be calculated on the remaining balance, which would be significantly lower. Her tax burden in her 70s and 80s would be a fraction of what it would have been if she had left the IRA untouched. And because she delayed filing for her own Social Security until 70, her benefit would grow by 8% per year, giving her a significantly higher monthly payment for the rest of her life. Patricia listened, she took notes, and then she said, "Why didn't anyone tell me this before?" And I said, "Because most financial advisors are not elder law attorneys, and most CPAs only see you once a year when the damage is already done." Now let me be very clear about something. The strategy I just described to Patricia does not work for everyone. It works if you have a traditional IRA or 401k that you can convert. It works if you have other income or savings you can live on while you delay Social Security. It works if you are disciplined enough to execute the conversions year after year without getting spooked. And it works best if you start before you file for Social Security, because once you file, your benefit counts toward your combined income and it shrinks the conversion window. Robert did not have that option. He had a pension, no traditional IRA to speak of, and he had already filed. Patricia had all the right pieces in place, but she almost made the same mistake Robert did. The difference was timing. Patricia came to see me 6 months before she filed. Robert came to see me 3 years after. So what do you do if you are sitting here right now wondering whether this applies to you? Let me walk you through the exact steps you need to take, and I am going to give you a simple test you can run on your own situation in the next 48 hours. Step 1. Calculate your projected combined income. Take your adjusted gross income from last year's tax return. Add any tax-exempt interest you earned from municipal bonds or other sources. Then add 1/2 of your expected Social Security benefit if you have not filed yet, or 1/2 of what you are currently receiving if you already filed. That number is your combined income. If you are single and that number is above $34,000, or if you are married filing jointly and it is above $44,000, you are in the 85% taxation zone. Write that number down. Step 2. Look at your retirement accounts. Do you have a traditional IRA or a traditional 401k? If yes, write down the total balance. If you are under 73, you are not taking required minimum distributions yet, but you will be. Go to any RMD calculator online and plug in your current balance and your age. That will show you what the government is going to force you to withdraw every year starting at 73. Add that RMD amount to your combined income number from step 1. Does it push you higher? Does it make your tax situation worse? If yes, you have a problem that needs solving now, not later. Step 3. If you have not filed for Social Security yet, run the math on delaying. Every year you delay between 62 and 70, your benefit grows by approximately 8%. If you can afford to wait, even waiting from 62 to 65 gives you a 24% higher benefit for the rest of your life. But more importantly, delaying gives you years where your Social Security is not counting toward your combined income, which means you have more room to do Roth conversions or other income planning strategies without triggering the taxation of benefits you are not even collecting yet. Step 4. Talk to a CPA or a tax advisor who specializes in retirement income planning before you make any moves. Not all CPAs understand the Social Security taxation rules in depth. You want someone who can model out your specific situation year by year and show you exactly what your tax bill will look like at 62, at 65, at 70, and at 73 when RMDs kick in. If your current CPA cannot do that, find one who can. This is not general tax prep. This is retirement income tax strategy, and it is a different skill set. Step 5. If you have already filed for Social Security and you are past full retirement age, ask about the suspension option. You can voluntarily suspend your benefits, and while they are suspended, they will grow at 8% per year until you turn 70. You will not get back the money you already collected, but you can stop the bleeding and increase your future benefit. This does not work if you filed early and you are not at full retirement age yet, but if you are at full retirement age or older, suspension is on the table. Most people do not know this option exists. Now I want to address the elephant in the room. Some of you are thinking, Hal, this sounds great, but I cannot afford to delay Social Security. I need that money now. And I hear you. I am not going to stand here and tell you to delay if delaying means you cannot pay your rent or put food on the table. What I am telling you is this. If you can delay even by 1 or 2 years, the math almost always works in your favor. And if you cannot delay, at the very least, understand what you are walking into so you are not blindsided by a tax bill 3 years from now. Robert's CPA was right. There is a way to cut your tax bill on Social Security down to 0 or close to it. But that way requires planning, it requires the right accounts, and it requires action before you file. If you have already filed and you are locked in, your options are more limited, but they are not gone. You can still use qualified charitable distributions if you are over 70 and a half. You can still look at income timing strategies. You can still make sure you are not making it worse by taking big IRA withdrawals in years when you do not need to. The biggest mistake I see people make is assuming Social Security is simple. File at 62, get a check, live your life. It is not that simple. Social Security interacts with every other piece of your retirement income, and if you do not understand how those pieces fit together, you are going to pay for it, literally. If this video helped you see something you did not see before, I would appreciate it if you shared it with someone who needs to hear it. And if you have questions about your own situation, leave them in the comments. I read every single one, and Kathy and I do our best to point people in the right direction. I'm Hal Whitfield. Knowledge is your best policy.